Good morning, everyone, and welcome to the Westwood U.S. Values Second Quarter Update and Sector Spotlight. Today, our U.S. Value Portfolio team will review the second quarter of 2024 from the macro perspective, provide a little bit of insight on what's driving the markets, and share the economic outlook that drives their stock selection. We will then turn to the financial sector, where we will have a deep dive discussion on the impact that interest rates have on banks, as rates have risen so much over the past couple of years and as they may begin falling here over the next 12 to 24 months. My name is Harry Breda. I'm a senior product manager here with Westwood, and I'm going to be your host today as I cover the U.S. Value team and a few others of the strategies here at Westwood. Joining me today is Matt Lockridge. He's the head of our U.S. Value team, and he's a portfolio manager on our large cap and small cap strategies. In addition, Matt covers research for the consumer staples and the consumer discretionary sectors. Also on the call is Kyle Martin. He is our analyst covering the financial sector and banks in particular. Kyle covers banks both large and small, as well as a few other industries such as automobiles. We're excited to have them both here today to discuss this with you. A brief word about our agenda today. So first of all, I'm going to give a little bit of an overview on the U.S. value investment process and philosophy. Then Matt will provide an overview of the economy and the stock market with a little bit of perspective on what's happening and driving stock market returns. Matt will also share the U.S. value economic framework, which takes several economic variables and puts them into a structure that the entire team uses in their fundamental analysis process. This framework ensures that the team shares a common baseline for interest rates, commodity prices, manufacturing input and output, and economic growth indicators. Then we'll turn to Kyle, who will delve into how banks earn their profits and how they will be adapting to this changing interest rate environment. As a quick reminder, as a fundamental investment manager, while we're here, let's give you first a quick refresher on what we do here at Westwood. Our U.S. value team seeks to identify companies at the intersection of quality and value, with our fundamental analysis as key to the investment process. For more than 4 decades as investment managers, we have focused on value investing, managing portfolios across the capitalization spectrum. Our team of 11 investment professionals are research analysts first, as well as portfolio managers, organized by industry rather than by market capitalization. Our approach to value is to find companies at the intersection of quality and value, companies that are undervalued and mispriced, yet quality businesses with a potential for attractive future returns. One quick reminder, this webinar is being recorded and we will send a link to the video along with the slides by email to all who have registered for the call. We will also leave time at the end for questions, so please use the Q&A box at the bottom of your screen. Again, if you have questions during the presentation, use the Q&A box at the bottom of the screen and we'll do our best to get to everyone's questions. And now I will turn it over to Matt for the second quarter overview.
All right, thanks, Harry, and hello, everyone. I appreciate your time today. So just at a very high level setting everyone with performance. So for the second quarter, the S&P was up 4%. We saw the large cap asset class outperform small caps. We'll get in a lot more detail into that in just a moment. Growth outperformed value. In the bottom left, you see from a sector standpoint in the quarter, we all know what was going on in technology. Names like NVIDIA up 36-37%. On the flip side, energy, industrials, materials, some of the best performers in 1Q underperformed a bit in the second quarter. On the next slide, slide 6, we start to really dive into the attribution of the market. And so you can see at a high level, that top line, the S&P 500, it was really a good balance of improvement in earnings expectations of about 8% and an expansion in the multiple of about 7% to drive that total return of 15. As you look by sector, again, technology, 21% of multiple expansion, again, given the exuberance around artificial intelligence. But interestingly, energy was the area with the second most multiple expansion in the first half of the year, I should say. We had some of the larger integrateds with negative earnings growth year over year. Some refining businesses also had difficult compares, but the market continues to look right through that. On the flip side, for the first half of the year, REITs saw the biggest multiple compression. Most of that was actually in the first quarter as some of the fears around office specifically started to permeate through the market. On the next slide, we really start diving into the biggest dynamic that we saw in the second quarter and really year to date, and that's the dramatic outperformance of large cap securities over small cap. We manage assets up and down the market cap spectrum here within US Value, and so we definitely saw this at play in our work during the quarter. And what this chart shows is the S&P 500 market cap index relative to the equal weighted version of the S&P. And you can see the first half of this year, you've seen the most outperformance of the market cap weighted over this entire time series. So even more than we saw last year, which was fairly dramatic. On the next slide, taking that a little bit further, we're showing now the Russell 2000, so the small cap index, as a percentage of the S&P 500 in terms of market cap. And we're now at a low for this data series of 6%. So the Russell 2000 is only 6% of the market cap of the S&P 500, which is really a 2 standard deviation move over this time series. And it is, in our opinion, setting the stage for a reversal, that pendulum swing back in favor of small caps, just given how stretched some of these metrics look. And we're starting to see some of that early in the third quarter. On the next slide, we really start getting into, well, why is this? Why are we seeing this, this type of trend in favor of large caps? And what we're showing here is quarterly revenue growth for the Magnificent Seven stocks, the S&P 500 excluding those 7 stocks, and then the small cap universe. And what you really see here is the Magnificent Seven is truly an asset class in and of itself in terms of the growth rates that they've been showing over the last several quarters. But even excluding those 7 securities, large cap companies continue to show greater revenue growth than their small cap peers. So when we've been in this period of economic concern, a lot of folks have talked about, the fear of tipping into a recession. It's the market really searching out areas of growth or companies with idiosyncratic opportunities for growth. And so you've seen investors flocking towards that. Another way of looking at this is on the next slide, where we're looking at a little bit longer time series now. We're looking at inflation adjusted revenue for domestic businesses, excluding those 7 magnificent stocks. And what you see here is that while there has been a recovery since COVID, we're still below that pre-COVID trend line of growth. So excluding those 7 huge stocks, the rest of the domestic businesses are not growing as they were pre-COVID. So again, this is why the market has just been searching for growth, and you've seen that pendulum really swing to the large growth style box. On the next slide, so what changes this? How does the pendulum swing back? First, valuation. So we're in a good spot, as we touched on earlier. But secondly, you need to start seeing growth rates in other areas of the market improve, in our opinion. And so here we show earnings and sales growth estimates for 2025 for large cap and the Russell 2000. Now, caveat this with, this is one point in time. This is where we stand here today. We're in the middle of second quarter 2024 earnings, which is a very important time period because companies are giving their updated guidance for full year 24, and those are the numbers that analysts will use to calibrate their 2025 estimates. So again, take this with somewhat of a caveat. But as we stand here today, the small cap asset class is set to have faster revenue growth and earnings growth as we get into 2025. So should this hold and the valuation is as stretched as it is, we wouldn't be surprised if the trend we've seen so far in 3Q continues. Now, wrapping up this topic on the next slide, it's very difficult to truly say when we see a shift back out of growth into value, out of large into small. But in our perspective, it makes a lot of sense to stay diversified, stay exposed to small cap securities, just given the valuation prospects, given the growth expected in the years ahead. And wherever you are in that small cap asset class, whether it's small cap growth, small cap core, or small cap value, it continues to make a lot of sense to us to focus on high quality businesses. What we're showing here on this chart is a proxy for quality, ROIC. And we've looked at small value, small core, small growth, those highest quintiles of ROIC relative to the lowest quintiles. And what you see across all of the different flavors of small cap is that year to date, high return on invested capital has been a helpful driver of returns. And this is true in longer time series as well. And so again, no matter where you are within small cap, to us, it makes a lot of sense to continue to focus on that higher quality end of the spectrum. So just wrapping up on the next slide with our economic framework. As Harry had mentioned, we put this out each quarter. We separate this out into 4 quadrants, which are tied to the 4 internal research groups we have here within US Value. Key observations as we stand here today at the end of the second quarter is, number one, given the progress that we've seen on inflation, the Fed is likely to begin lowering rates in the back half of this year. And so you can see our estimates of Fed funds indicate a couple 25 basis point moves through the remainder of this year, and then further reduction next year. But keep in mind that the lagged effects of higher interest rates are still flowing through the economy. We're starting to see more and more cracks in employment data. We're continuing to hear of a very difficult consumer environment. We're getting earnings reports every day from consumer companies showing and telling us that the consumer is stretched. And so in our estimates, the consumer will continue to decelerate as we move over the next year. In terms of the commodity complex in the top right, we're really forecasting a range-bound environment. And in the bottom right, manufacturing, we see the PMI, which we look at a lot, really hovering right around that expansion contraction territory. We're flipping into expansion, but it's not gangbusters in our estimate by any means the rest of this year. And then just lastly, we all know there's an election coming up in November. And so whether it's tariffs or taxes or regulation changes, energy policy, all of those clearly will have an impact on economic growth as we get into 2025. So I'll pause there and hand it over to Kyle to walk through our view on the financial sector.
Good morning. My name is Kyle Martin. I'm Westwood's Bank and Capital Markets Analyst. It is my honor to be here to discuss the outlook for banks in light of the changing rate outlook. As you know, there's been a lot of focus on the Fed and the outlook for rates in recent quarters. Rates, of course, have a big impact on the financial sector and particularly the banks. So with the FOMC likely to begin lowering rates in September, we are positive on banks. That sounds strange to most. I've been asked frequently, after a decade of bank management teams complaining about zero interest rates and promising higher returns in a more normalized rate environment, how can lower rates possibly be good for the banking system? And this presentation aims to answer that question. So I'll take us through why banks have wanted higher rates, why higher rates have proved to be too much of a good thing, why lower rates are ironically beneficial, and then lastly, what type of banks we're buying right now. So first, let's define terms here on slide 15. So we're focused today on banks' net interest income and how the rate outlook influences net interest income. Net interest income is 75 to 80% of revenue at regional and community banks. It's about 55 to 65% of revenue at the largest banks. And it's a very high incremental margin revenue stream, meaning it's very important to earnings growth. Net interest income is a function of two things: earning assets, interest earning assets, and net interest margin. Net interest margin is simply the difference between the yield on interest earning assets and then the cost of funding those assets. So bank customers will bring to the bank an asset that they would like to borrow against, a home, an office building, an industrial warehouse, a business idea, working capital, you name it. The bank then, of course, underwrites that cash flow and issues short-term liabilities to the customer to fund that asset. This is classic maturity transformation, borrowing short, lending long. In the spring of 2023, maturity transformation was treated like a four-letter word, which I think loses sight of the importance of maturity transformation in a high functioning economy. Again, a bank takes risky projects, long-term assets, and then they turn them into liquid deposits. Bank deposits account for virtually all of the money supply in the US economy. Money, of course, is involved in virtually all economic transactions, which allows us to overcome what economists call the double coincidence of wants, meaning without money, we would be forced to barter. Economic activity and well-being would be significantly lower in the absence of money. One of the main reasons the Great Depression was a depression and not a recession was the 30% decline in money supply from 1930 to 1933. So when you want to get rid of maturity transformation, be careful what you ask for. All right, I'll climb off my soapbox now, and on the next slide, we'll take a look at more recent history, which will allow us to make a few observations about net interest margin and why banks have been begging for higher rates. You can see that over the last 40 years, net interest margins have been in secular decline alongside the secular decline in the Fed funds rate. The Fed funds rate pinned at the zero lower bound was particularly problematic. A bank will generate excess spread on both the asset and liability side of their balance sheet. And the goal is to price assets with as wide of a spread as possible over a duration matched risk-free rate, while also pricing deposits as low as possible below the risk-free rate. When the overnight risk-free rate is 12 basis points, which is where it was for much of the last 15 years, it's altogether impossible to generate spread from your deposit base. And that's led to some sclerosis in deposit gathering muscle, which has been exposed with this rapid rise in interest rates over the last 2 years. We'll touch on that more in a moment. But as the bottom chart shows, the Fed funds rate is obviously extremely important, but the shape of the curve is also very important. And here we chart the 10-year Treasury minus the 3-month T-bill rate against bank net interest margins, which 10-year and 3-month is a rough approximation of the asset and liability duration of a bank. While the Fed funds rate and net interest margins have been in secular decline, as the yield curve steepens, there is some opportunity to expand asset yields and therefore NIM in the short and medium term. Banks are price takers. It's an extremely competitive industry, particularly with growth in capital markets and private credit, but no one is going to price loans below the risk-free rate. So as the 10-year risk-free rate rises, ceteris paribus, long duration loan yields will rise as well. Conversely, as the curve inverts, the spread between the yield on a bank's asset and liabilities compresses. So in the long run, the Fed fund rate dominates. An inability to earn spread on your deposits is crippling to your net interest margin. You'll notice in 2015, despite the curve having 225 basis points of positive slope, NIMs were actually lower than they were in 2007 with the curve inverted by 75 basis points. I think this point has underlined the importance of the Fed funds rate by the near perfect correlation in the Fed funds rate and net interest margins beginning in 2016, when the Fed first moved off the zero lower bound. This is exactly why banks have been begging for a more normalized rate environment, that ability to earn spread on your deposit base. So that's the story with net interest margin. But again, net interest income is a function of net interest margin and earning assets. So what should we know about the earning asset growth and rates? On the next slide, you can see that loan growth and changes in the Fed funds rate are positively correlated. Loan growth is procyclical, as is the Fed funds rate. When the Fed perceives that the economy is overheating, it raises interest rates to slow the economy. With lagged effect, that increase in interest rates will begin to slow the economy, and alongside it, loan growth slows as well. And yet, looking at slide 18, despite banks being positively correlated with the 2-year yield for much of the last 20 years, for the reasons I just mentioned, the 2-year yield is a good proxy for the expectations of the Fed funds rate. In the last 2 years, that correlation has flipped negative. So banks have been rising when the 2-year yield has been falling. This is a bit counterintuitive. We've seen that in recent years, net interest margin has been highly correlated with the Fed funds rate, that loan growth is highly correlated with changes in the Fed funds rate. Are bank investors masochists? They might be, but that's not the point. The problem is the dose makes the poison. You can see on slide 19, in a vacuum, a 5.5% Fed funds rate is not bad for banks. What's bad for banks is the magnitude of the rate increases and the speed with which those rate increases were executed. So going from 25 basis points to 5.5% on the Fed funds rate in just 17 months created three problems. Number one, after initial phase of net interest margin expansion, liabilities have been repricing faster than assets in recent quarters, which is compressing the net interest margin. Number two, CRE valuations are declining, which is increasing credit costs. CRE losses have been the downfall of many a bank. And number three, negative marks on securities are putting downward pressure on capital ratios. Inadequate capital alongside ramping credit losses is an existential issue for banks. This is a toxic mixture. So let's touch on each of these three concerns in a little bit more detail. On slide 20, you can see the net interest margin for the industry and then for community banks and the deposit flows over the last 15, 16 years. When bank analysts talk about deposit repricing in a rate cycle, we talk about deposit beta, which is simply the ratio of deposit cost increases over the rate and change of the Fed funds rate. So if the Fed funds rate rises by 25 basis points and a bank's deposit costs rise by 5 basis points, they have a 20% deposit beta. Deposit betas tend to increase with the duration of the rate cycle. The deposit beta on an initial 25 basis point increase in the Fed funds rate is going to be negligible, but the deposit beta on the 10th 25 basis point increase, for example, is going to be very high. To compare across cycles, and particularly in a cycle where the Fed funds rate might be rising very rapidly, we'll look at the cumulative deposit beta. That is, if the Fed funds rate goes up 250 basis points cumulatively across the cycle, and deposit costs rise by, say, 125 basis points, the cumulative deposit beta is 50%. In the current rate cycle that started in March of 2022, we've seen the quickest increase in cumulative deposit beta of any cycle in the modern era. Now, some banks' assets are, of course, floating rate, but the majority, especially in the community bank side, are longer duration fixed rate assets. And these assets reprice over time through contractual maturity, sale of the asset, the underlying building, the underlying business, or refinancing ahead of maturity to take advantage of advantageous financial conditions. Fixed rate assets, though, are negatively convex, meaning as rates rise, the duration extends, and that repricing occurs much more slowly than it would have otherwise. Therefore, like we've been seeing here recently, liability repricing often dominates. That's exactly what we're seeing in this greater degradation in net interest margin at the community and regional banks. When Silicon Valley failed, bank depositors were suddenly awoken to the fact that above insured deposit limits, which are frankly very, very low, they are unsecured creditors of the bank. And this is particularly true of banks that are deemed non-systemically important, which is virtually every bank below the top 15 banks. If Main Street Bank fails, the Treasury is very unlikely to bail them out. That is not true for JP Morgan. So JP Morgan depositors have an implicit FDIC insurance on all of their deposits, an insurance that they're not paying for. So what we saw is deposits fled the regional and the community banks towards the largest banks, and then in some cases to collateralize deposit-like products like money market funds or CDs. To keep deposits, small banks had to reprice high enough to account for the perceived risks of their institution failing. In other words, to price their deposits like unsecured claims on their assets. And there were, of course, concerns about the value of their assets. Initially, the concerns was about security marks, which we'll touch on in a moment, but that quickly shifted to concerns about CRE valuations, which make up the majority of assets at smaller banks. On slide 21, you can see a price index for commercial real estate. We're currently seeing a pretty standard cyclical slowdown, but That said, transaction volumes are the lowest they've been since 2010. So determining market value is a bit of a challenge. We're relying on dated appraisals and a small number of transactions that are either top tier properties or distressed properties. So we're not getting a great look at what is actually happening throughout the market. What we do know is that certain CRE asset classes are seeing more pressure than others. The two main concerns right now are office CRE, with work from home policies becoming standard, and multifamily because of very low cap rates coming into this rate cycle. So just taking a step back and thinking about this conceptually, we have an illustration on the right-hand side of the slide that looks at what a CRE office lender might be looking at as the loan matures and needs to be refinanced. So CRE loans are typically fixed rate loans. They have a 5-year maturity, 25 to 30-year amortization schedule. Here we have at time zero, a $1 million office building with a $750,000 loan at a 5% rate. This would have been very standard heading into this rate cycle. So that's a 75% LTV. Debt service coverage ratio is 1.3 times. You fast forward 5 years though, and due to the emergence of work from home, the increase in interest rates, the value of the asset's down about 20%. That's what we're seeing so far on the office side. With incremental bank funding costs up 4% and the greater risk involved in office lending, the bank is only going to be willing to refinance that loan at an 8.5% rate, which is generous. That implies some spread compression. So absent some remediation, the loan to value is now 86%, and the debt service coverage ratio is about 1 times, meaning the property is barely generating enough income to service the loan. That's not a loan that a regulated bank can make. The examiners, the regulators are going to be tapping you on the shoulder if you're trying to make a loan that looks like this. So the sponsor needs to put in a lot more equity to deleverage that loan, lower the loan to value, and improve that debt service coverage ratio. That's an extremely difficult conversation to have with the sponsor who's seen the equity in that property decline by 55% already. Those conversations, for the most part, have been successful, but sponsors don't have unlimited funds. They're going to have to walk away from some properties, meaning banks will see an increase in defaults. And that's exactly what we've seen in the CMBS market, the commercial mortgage-backed service market. LTVs going into this cycle were much higher, 80 to 85%. The asset value being down 20% means that the equity in those properties has been completely wiped out. Sponsors are not willing to kick in another chunk of equity to keep this going when they don't have any skin in the game any longer, no more equity in that property. Now, looking at the next slide, what if I told you that risk-free assets are also a problem? So looking back at the panic of spring 2023, the banks that failed or were forced to sell at washout prices, which is just failure by another name, all had negative securities marks that overwhelmed their capital position. There were a handful of banks that were completely insolvent when their securities portfolios were fully marked to market. Uninsured depositors, again, who are unsecured creditors of the bank, had an incentive to run, and of course they did. The fundamental assumption in banking, which is shared by regulators, examiners, and bank management teams, is that while deposits are legally short duration, you can withdraw your deposits overnight or even intraday, they are in practice long duration. However, when you're facing deposit outflows of a certain magnitude, to satisfy those outflows, you need to generate some liquidity, and that typically means selling liquid assets. Beyond reserves, the most liquid asset on a bank's balance sheet are treasuries. Now, outside of the 8 largest banks, unrealized losses on your available for sale securities are excluded from regulatory capital. But when you turn those unrealized losses into realized losses by selling those securities to generate liquidity, it does impact your regulatory capital. And to make matters worse, you can see the large losses here on the held to maturity side. If you take a single security out of your held to maturity portfolio, you have to mark the entire held to maturity portfolio to market. So realizing this, investors quickly began to circle the banks who were short on capital with securities fully marked to market, and that created several bank failures. So I'll repeat, the dose makes the poison. Higher rates in a vacuum are good for banks, but when rates rise as quickly as they did off of a base of 0, it creates quite a few problems. And Rapid deposit repricing, negative marks on securities, declining CRE values, again, are a toxic mix. This is precisely why in the last 2 years, banks have become negatively correlated with rates. Investors are bidding banks today on the expectation that the Fed will soon be cutting rates. There's some implications for that on the next slide. So what then does a lower Fed funds rate mean for the banking system? Well, reducing interest rates will lower the pressure on deposit costs. They'll reduce the incentive for customers to move deposits into higher yielding products. Lower rates will also support the value of yield-oriented assets like commercial real estate. Lower rates will also stimulate loan growth. That loan we looked at earlier, that hypothetical office loan that wouldn't work at 9%, would work or will work better at a 7% rate. Similarly, if you're looking to expand your factory, expand your business, a loan at 7% is much more palatable than a loan at 9%. And then lastly, lowering rates will recapitalize the banking system. Negative security marks would decline substantially. That would boost your fully marked capital ratios and significantly recapitalize the entire system. The Fed raising rates like they did was like boiling a pot of frogs, I like to say. And the frogs with pre-existing conditions, poor business models, those went first. But if you keep that water boiling long enough, even the healthier frogs are going to begin to fall. That's not what we want to see. So as I mentioned at the onset, we're bullish banks. We think lower rates is going to reduce the bite of the 3 most prominent bear theses on the banks, which raises a question, which banks should you buy today? And there are 2 theories on this. Number 1, buy the banks with poor deposit franchises, the ones paying the most for deposits right now, because as rates come down, their deposit rates will come down quicker, leading to superior earnings growth. Similarly, buy banks with outsized CRE exposure, because as concerns around CRE credit dissipate, these banks will see a bigger valuation uplift as failure is taken off the table. The second theory is buy the best banks, the banks with superior deposit franchises, the ones that are paying the lowest for their deposits today. If a bank has been able to lag deposit pricing with everything that we've experienced over the last 2 years, that's a bank with a differentiated offering, a differentiated value proposition to clients. And it's provably so, again, after everything we've seen. I can appreciate point 1 as a trade, but as you know, we're value investors here at Westwood. Purchase price matters, but equally important in our eyes is quality. Buying low quality banks, even for a trade, in my view, is exposing yourself to a risk that's unworthy of the potential short-term return. As I mentioned earlier, a bank earns spread on its assets and its deposits. When interest rates rise, the value of assets falls. Banks hedge that risk with their deposit franchise, right? As rates rise, the value of the deposit franchise rises alongside it, but only in as much as your depositors stay put. Assets walk out the door at market value, deposits leave at par. A bank's deposit franchise is effectively an interest rate swap where the bank is paying fixed in terms of its deposit network and its branches, and it receives floating, that deposit spread. A bank with low deposit costs is earning a higher deposit spread. So assuming rates don't go back down to the 0 lower bound, which we don't expect, high quality deposit franchises, even with rates a bit lower than where they are today, are going to be earning a meaningful spread on their deposits. You always have to keep in mind with banks that growing loans is easy. Money is fungible. There's an unlimited demand for underpriced loans. Building a durable, low-cost deposit franchise is difficult, and sustaining it is even more difficult. Many banks that had high-quality deposit franchises coming into the spring of 2023 saw that franchise value eroded in the blink of an eye. We've generated superior returns for clients with doing the fundamental analysis required to identify those superior deposit bases when they were being uncompensated for those efforts, when growing loans was the name of the game. It seems unwise to us to abandon those banks when they're finally getting to enjoy the fruit of that labor. So with that, I'll open it up for questions.
Thank you, Kyle. That was very interesting. I always feel like after talking to you, I should get an hour of CPE credit for listening and for understanding what's going on here. So I will remind you all again, if you're interested in asking a question, please use the Q&A button at the bottom of the page to submit questions. We're eager and ready to hear them. We have a first question from our field here. This is for Kyle. So you mentioned a little bit about the quality of the bank and the type of banks you're looking for as we go forward into this future rate cutting regime. Any thoughts from you as to whether we're looking more at a bank with a national footprint, or are we looking more at smaller regional banks?
Yeah, I think it's a little bit of both. I think what we have learned is that relationships really matter in establishing a strong deposit base. So there are many small banks, very small banks that are very important to their community that, when all this was happening in March of 2023, we're able to speak to each of their clients. And you'd be surprised that many of these small banks, their biggest depositors have the cell phone number of the CEO, of the CFO. And through that relationship, you can maintain that deposit base. Whereas at a large bank, really the super regional bank, that doesn't have that implicit deposit guarantee that the largest banks do, that's much more difficult. So I think it's a mixture, it's a barbell, right? I mean, so I think you want to buy those banks that are very strong in their community, that really focus on relationship and service. At the same time, like I mentioned at the onset, we can't ignore the fact that as banks were failing, everybody was moving their deposits to the largest banks, the JP Morgans, the Bank of Americas, and even the Wells Fargos. So there is some revealed preference there for these banks that have the implicit deposit insurance of the Treasury. So it's a mixture of both. And it's tough because it's one of those things that the balance sheet, the income statement is not going to tell you who has a strong deposit franchise necessarily. You've really got to do the work, meet with the management team, talk to some of their biggest clients to determine, what exactly are they getting from their bank? What exactly is the bank offering? How are they able to keep deposits? How are they able to pay low rates?
Interesting. You mentioned briefly that when the customers had been moving to some of the largest banks for the implied insurance that comes from being with the systemic, highly systemic risk banks. Um, there's also some discussion at the time around changing some of the FDIC rules. This was back when Silicon Valley Bank failed a couple of years ago. Has there been any movement on that? Do we anticipate any changes to FDIC insurance rules in the coming, and how would that impact banks?
Unfortunately, a change in FDIC insurance would require an act of Congress. And while there were some discussions early on, and the FDIC even put out a few proposals on how they would recommend FDIC insurance be changed, it doesn't seem like there is much desire to make a change at this point. The last time we raised the FDIC insurance deposit level was in 2008 during the financial crisis. If you were to index the FDIC insurance level to nominal GDP, it would be roughly twice what it is today. So instead of 250, it would be 500,000. There are concerns that by blanket guaranteeing all deposits, you would create a moral hazard. The banks would start taking undue risks, knowing that they have the backstop of the government. The argument against that is we already have 70% of bank assets in that position. We might as well make these banks pay for that insurance. So there's a lot of talk, but it doesn't seem like anything is happening or will happen in the near future. So particularly with the way that many of the small banks have performed well. And, I can tell you Cullen Frost here in town is one of our favorite banks. They're an extremely conservative, well-run bank. They say we shouldn't make wholesale changes based on a few banks failing in California and New York. My view is something needs to change. I don't think this is a tenable setup that we have now, but it doesn't seem like anything is forthcoming.
Yeah, that's a good answer. And for those of you who had the term moral hazard on your bingo card, you may have not marked that spot off. I had that because I had several talks with Kyle in the past, and I knew that one was going to come up at some point today. So let's turn another question just came in, and this is probably more for Matt, but it can be for both you guys. You talked a little bit about the Mag 7 and the growth that has happened with the Mag 7 relative to the rest of the S&P 500. What are some of the risks to that growth outlook, and how might we see, possible chinks in the armor of those companies?
Sure. To us, we've talked about this internally. I think if you were to see questions emerge, serious questions on the benefits of artificial intelligence, whether it's efficiency gains, productivity initiatives, that to us, would really be an issue for that trade. And, we're in this period now where the market is rewarding, the more you spend, the more reward you get. And so if there was a belief that the return on that growing investment was not nearly as good as legacy business lines, and that incremental returns on capital were going to continue to march lower, that to us would be a real damaging thought to the euphoria that we've seen in AI. And, we're at the point now where the market is so concentrated. The S&P has almost become a sector fund for technology. And should there be, true fears on that very important part of technology in the overall S&P, it would definitely cause some turbulence in the markets more broadly.
I think some of the statistics I saw during the review of the quarter end showed that 37.5% of the S&P 500 is in just the top 10 stocks in the S&P. It's clearly a highly concentrated index at this point, which again makes the case for active managers. If you want 37.5% in your strategy in your top 10, at least know what you're doing and know why it's there. Well, and with that, there's no further questions on our table today. So I wanted to close this out by flipping to our disclosure. And I will want to say thank you again to Matt and Kyle for joining us today, and for everything they discussed in terms of the commentary on the markets, as well as the commentary on the bank sector. Just a quick reminder that we'll be sending a link out to the recording presentation and the slides in the next week or so. So please be on the lookout for that. Also, be sure to take a few seconds to review the exciting disclosure on this slide. Again, thank you for your time today, and we look forward to seeing you soon.